Hello and welcome to the weekly market commentary. I'm your host, Chalekian of LPL Financial. How about that game yesterday? Congratulations to the New England Patriots for winning Super Bowl 49. They were able to defeat the defending champions, the Seattle Seahawks, 28-24 in a thrilling finish. The game was close and the back and forth kept me glued to the TV. Now I wish I could say the same about the commercials this year. Besides New England, the only other clear-cut winner was social media. Both Facebook and Twitter was buzzing with Super Bowl activity. In any case, congrats to the Patriots. Now let's review the markets from last week. We had the markets close lower last week. The S&P 500 was down 2.75%, the Dow was down 2.83%, and the Nasdaq was down 2.56%, thus sending all of the major indexes for the US lower for the year. Now we also had some major economic reports from last week. Durable goods dropped 3.4%, new home sales rose by 481,000, initial jobless claims were at 265,000, consumer sentiment was down to 98.1, and as we predicted in our last video, the FOMC did not make any changes in their monetary policy. Now let's take a look at our focus list for this week. So how is quantitative easing going to work in Europe? Well, we really don't think it is. If you think about it, QE is tough enough in one country to handle. How are they going to handle it with a whole bunch of different countries that have their own systems and their own economies? It's going to be a real tough deal. Now, we also have to take into consideration what happened the other week with the Swiss National Bank pulling out of the euro. What if all the other countries start to pull out of euro? It could be real tough for them to group together as a whole and make things happen. We also have another factor to take into consideration, the dollar versus the euro. So think about this. If you're investing globally or domestically, where are these companies domiciled? It can make a difference as far as currency fluctuation. And as the dollar gets stronger, and it probably will, compared to these other currencies, you can lose a lot of money. So Apple announced today that they're going to be selling bonds. What does this currently mean for the interest rates in the United States? One school of thought is that interest rates are at an all-time low and Apple wants to try to maximize on that. A second school of thought is, what do they need all this cash for? Apple's sitting on billions of dollars in cash. Are they looking at acquiring another company or another major deal? We'll find out soon enough, I'm sure. Last week we had Shake Shack that went public, and in their market debut, they went up 130%. Now they're worth almost $2 billion. All of this for just 63 burger joints. Can you say IPO frenzy? Man, I'm in the wrong business. Everyone's obviously talking about oil prices and how they've come down. Now this is great for the consumers. Just the other day, my wife was telling me that she filled up her tank of gas for $40. She can't remember the last time that she paid $40 for a full tank of gas. It was usually around $80. In any case, it's great for the consumer, but we're not taking into consideration how it could also be bad for the economy. How is that affecting all the people that are going to probably be out of jobs as these oil refineries and the drillers start to lay off a lot of their workers? We can have possibly hundreds of thousands of people get laid off. And keep in mind, these are the people that are probably getting six-figure salaries, and it's going to affect our economy one way or another. Now, we don't expect oil prices to remain at these lows. They've already started to creep back up, and we saw that last week. But we expect, like I mentioned in another video, that we're going to see them higher up by the end of the year. Lastly, that leads us to Chevron. With oil trading down 50% at a 6-year low, we're going to see a lot of these major refineries like Chevron, ConocoPhillips, and Exxon struggle. Now, they reported fourth quarter earnings, which were lower by 18% from the year prior. This is going to be an ongoing trend for the next couple of quarters. Hopefully, we'll see that start to turn around. Chevron Chairman and CEO John Watson said in a statement last Friday, "Our 2014 earnings were down from the previous year, largely due to the sharp decline in crude oil prices. Improved downstream results and higher gains on asset sales related to our divestment program partially offset the effect of lower crude prices. Although commodity prices have fallen recently, we believe long-term market fundamentals remain attractive." Now, in a separate announcement Friday morning, Chevron released its 2015 CapEx budget, saying that it expects to spend $35 billion in capital and exploratory investments this year. Now this budget is 13% lower than total investments made in 2014, due primarily to commodity prices. Following the release of Chevron's earnings results, shares of the stock dipped into negative territory. Now year over year, the stock is down about 8%. Zacks currently has the company ranked as a strong sell, but we here at Lake Avenue Financial think that this might be a good time to start building a nice position in Chevron. Now we don't expect that the next quarter will be a good one, but we think that's already baked into the current price. The current 4% dividend will also provide some cushion to any further downside in the share price. Thank you for watching our video. We'd love to hear your comments. Please remember to visit our website, lakeavfinancial.com. There you'll be able to watch some of our other videos, as well as read our blog posts and sign up for our newsletter. We can also find us on Twitter, LinkedIn, and Facebook. And remember, at Lake Avenue Financial, we manage your wealth with your goals in mind. Happy Groundhog's Day.